If you're an investor, you live with one fundamental question, right? How do you possibly measure the risk of something as wild and unpredictable as the stock market? For decades, we've really tried to tackle that question from two totally different angles. One that tries to calculate risk with a perfect formula, and another that tries to capture its feeling.
Okay, so let's dive in. It really all boils down to this one question. Is the market a rational machine that follows logical rules, or is it driven by the very human, very messy emotions of fear and greed? How you answer that question completely changes how you even try to measure risk.
So first up, let's look at the rational approach. For a long time, academics and finance tried to create these elegant formulas to explain stock returns. They believed that, deep down, the market had to follow a certain set of rules, kind of like physics governs the universe.
The first really big attempt at this was the capital asset pricing model. You've probably heard of it as CAPM. The idea was beautifully simple. A stock's risk could be boiled down to a single number, its beta, which just measured how much it tends to move when the overall market moves. It was a neat theory, but as it turns out, the market is a little bit more complicated than that.
Right, so to get closer to reality, researchers started adding more ingredients to the recipe. You get the famous Fama-French models, and they start adding factors like the size of a company or its value. Then later, they added even more, like profitability and investment strategy. The thinking was, look, if we just keep adding enough variables, we can perfect this formula and explain the whole shebang.
But here's the catch. Even with all these bells and whistles, study after study found that the models just weren't very good at predicting what stocks would actually do. One analysis of the European market found these models had an R-squared, which is just a fancy term for explanatory power, of less than 0.1. In other words, these super complex formulas could only explain a tiny fraction of what was really going on.
So if the formulas aren't working, what's plan B? Well, this led to a totally different idea. Instead of trying to write a perfect equation for risk, what if we could just measure the market's collective mood? What if we could take its emotional temperature in real time?
And that's exactly what the VIX is supposed to do. The VIX is basically a clever index built from options prices on the S&P 500, and what it's measuring is how much chaos investors expect to see over the next 30 days. It didn't take long for it to get that very famous nickname, the fear gauge.
And this chart just shows the relationship perfectly. The green line is the S&P 500, and the other lines are volatility indexes. You can see it clear as day. When the market goes up, fear goes down. But when the market takes a dive, fear absolutely spikes. They're like a seesaw, a perfect mirror image of each other.
So how do you read this thing? It's pretty straightforward. When the VIX is low, it suggests investors are calm, maybe even a little complacent. When the VIX is high, it means fear and uncertainty are running wild. It seems like the perfect real-time risk meter, doesn't it? Well, it has a fatal flaw.
And this brings us to the great flaw in all of this. It turns out that both approaches, the rational formulas and the emotional gauge, they both tend to break down at the exact moments you need them the most.
Just take a look at this number, negative 61.7%. What on earth could that possibly be?
That was the VIX's prediction error on September 16, 2008. We're talking about the day after Lehman Brothers filed for bankruptcy. This was a moment of absolute peak crisis, and our fear gauge was off by over 60%. It massively underestimated the chaos that was about to hit.
And listen, this wasn't some one-off fluke. Research found a systemic problem. The VIX is like a smoke detector that's way too sensitive most of the time. It goes off when you're just making toast. But then, when a real 5-alarm fire breaks out, it fails to make a sound. It consistently overestimates risk when things are calm, but then underestimates it during a real crash. This chart from the 2008 crisis just lays it all bare. See the green line? That's what the VIX was predicting. And the dashed red line? That's what actually happened. You can see it over and over again. Right at the peak of the panic, there's this huge, terrifying gap between the VIX forecast and cold, hard reality.
And this 3D chart makes it even clearer if you can believe it. Think of this as a landscape of the VIX's mistakes over time. That big mountain in the middle, that's the VIX overpredicting risk in normal times. But you see those deep blue canyons on the left? Those are the moments of crisis. And that's where the VIX is systematically, dangerously underpredicting the real danger.
So where does that leave us? We have these rational, brilliant formulas that can't explain reality, and we have an emotional gauge that literally breaks under pressure. What does this all really mean for how we should think about risk?
Okay, let's just break it down. Here are the key takeaways. First, the academic models, for all their complexity, are just incomplete. They miss the messy human part of the market. Second, the VIX, our so-called fear gauge, actually gives us a false sense of security because it fails precisely when we need that warning the most. At the end of the day, both approaches are imperfect, flawed tools for trying to predict the future.
Which really leaves us with a final fascinating question, doesn't it? If our most sophisticated attempts to measure risk, both through cold logic and by reading collective emotion, if they both break down in the face of a true crisis, then what is risk, really? Maybe it's something that can be managed, but never ever truly measured.